Welcome everyone to another episode of StableSchool podcast. I'm here with Nevin from the Reserve Protocol. Nevin, please introduce yourself, tell a little bit about yourself and Reserve Protocol.
Yeah, thanks for having me. So I'm Nevin, one of the co-founders of Reserve. I'm currently the president of Confusion Capital. It's like the treasury management entity within our ecosystem. And Reserve, the big idea behind Reserve in the long run is what we call asset-backed currency. Basically, we asked ourselves the question, if fiat money really does have issues, if the US dollar over the next 20 or 30 years were to fall apart, what should the world switch to and why? And I think, the top possible answers are gold or Bitcoin if you're looking outside the fiat world. And I think that those are real possible contenders. If you talk to the folks who really think about alt monetary policy, like a lot of people do think we could go back to a gold standard, and that's interesting. But the answer we landed on was, if you think about how people store their value today, pretty much everybody already does it with a diversified portfolio of some kind, right? You don't hold just this stock or just Bitcoin or just gold or whatever. You end up diversifying over many things. And so from our perspective, with the technology of smart contracts and blockchains, we think that it might make sense to have there be an asset that represents kind of an index of everything, like an index of all the world's assets, roughly. Not like literally everything, but like all of the liquid financialized assets, basically. And that would include native crypto assets like Bitcoin. It would also include things like gold and also equities and bonds, right? Just sort of a diversified portfolio of everything. If you imagine that being represented as a token, think about how cool it would be to go buy a bag of groceries and pay with like a tiny slice of all the world's assets. That's the thing that we think could ultimately make sense as sort of a totally inflation-proof, kind of bottom-up way for the world to store value and transact. So that's kind of the long-term vision behind Reserve. We can talk more about kind of the nuts and bolts of what we're up to now and how we think we could get there, but that's the long-term idea that motivates us.
So does this originate from a place where you're trying to solve inflation?
Yeah, I should have said that. Basically, it's two pieces. So, all fiat currencies end up inflating because governments and central banks choose to inflate them. They wouldn't have to. If you manage the supply in a different way, they would not inflate, but the incentives are so powerful that it always happens. But there's also the challenge with, it turns out that when you have a reserve currency that the whole world uses, that position actually can be a little bit more tenuous than it seems over a long enough time span. If you look at the reserve currencies before the dollar, it was the British pound before the dollar. Before that, it was the Dutch guilder. And basically, the problem is, if you're the nation with the reserve currency, you end up being able to borrow an enormous amount of money from the world. And you tend to do that. And you end up with a lot of debt over the course of time. And then the question is, how are you going to pay that debt? Where's that going to come from? Are you going to somehow suddenly raise your taxes massively for like decades in order to pay down that debt? Or are you going to default on that debt? And the thing that tends to happen is you print money and you pay the debt in nominal terms, but you devalue the currency. And that happened with the British pound and with the Dutch guilder. And if you look at the debt situation with the United States and the US dollar, it's like, well, maybe that's going to happen. Notwithstanding Elon's efforts with Doge to try to get the budget under control, I do think that is a move in the right direction. Is that going to be enough to steer us towards zero debt? Who knows? I think that would be the best outcome. I'm not opposed to the US dollar. I'm not opposed to the US having that position in the world. As an American, it benefits my interests and the way I see global politics. But yeah, we sort of think that it makes sense to have a backup plan in the case that the same thing happens to the dollar that happened to the prior two reserve currencies.
So do you then see, it sounds a little bit like what you're doing is just creating a currency for the world, like one currency for everyone.
Yeah, basically. Although we're not creating it directly. So we decided, there's this economist, Hayek, who popularized the idea of, hey, look, what gives us the best products? It's capitalism with open market competition. Let anybody create them and, people can buy the best ones. His thesis was essentially, let's do that with money. let's, instead of giving the government a monopoly on money, let's let anybody create their own money and let them compete in the market. And whichever currency is the best at all of the properties you need for a currency, it will end up being the consensus means of transaction. Well, powers that be have not chosen to do that. But in the world of blockchains and smart contracts, everything's permissionless. So we're kind of taking that approach. What we're doing is making it so that anybody can create what we call a DTF. A DTF is like an ETF, but in DeFi. It stands for Decentralized Token Folio rather than Exchange Traded Fund. And a DTF just means a token that represents some basket of other tokens, similar to how the S&P 500, that ETF's share would represent shares in those 500 companies. You can do the same thing with tokens, where you have a token that represents a basket of other tokens. And so we think that over 20 years, DTFs will become very popular, not just on Reserve, but on many platforms, in the same way that we have many lending protocols and AMMs and so on. And we think that the most popular DTF at the end of the day can just organically emerge. It's just at the top of the chart in terms of total market cap. That's sort of a shelling point of attention for everyone to say, like, oh, maybe this is an interesting alternative for us to hold in the case that fiat currencies are having problems, which again is kind of what we already do, but this is just a simpler way of doing it. And if you think about how right now Bitcoin's at the top of coin market cap, so it's natural to think of Bitcoin as that possible asset. Well, what if the thing that was at the top of coin market cap was instead an index of all the world's assets? It'd be a pretty natural conversation to have. So rather than try to engineer it, we decided let's take the approach of radical openness and let anybody create these as investment products. It's in the short term, we're basically building the decentralized version of BlackRock and letting DeFi do its thing. But we think in the long term, it might lead to this thing that we're excited about. Maybe it will, maybe it won't. We don't know.
Yeah. So okay. So right now, our tokens Reserve protocol. Is it a stablecoin then?
It's a good question. So the first version of the Reserve protocol we call the Reserve Yield protocol, and we just released yesterday the Reserve Index protocol. So the Yield protocol is optimized for kind of like the DeFi version of money market assets, where you're getting yield on some particular base asset, like US dollars or ETH are the main ones that people do this with. So there's an asset called ETH Plus that gets you diversified staking yield across all the staking providers. One called USD3, where you just hold it. It's like a stablecoin, but automatically generates the DeFi yield because the stablecoins are underlyingly lent out, unlike the blue chip DeFi platforms. So you can create a stablecoin, just like with ETF technology, you can create sort of an exchange-traded, money market fund. But the universe is a lot bigger than that. You can also create, a DTF that represents exposure to the broad crypto market, or exposure to just, AI coins, or exposure to, just the particular meme narrative on Base this week, or whatever. But yeah, you can create stablecoins this way. We do have some stablecoins that run on this technology that basically are generating that DeFi yield. And that's in the period of time where issuers have not been allowed to share the underlying treasury yield. This is kind of an answer to that. It's okay, fine, we'll get our yield from DeFi. And so we also have a fintech platform in the family called Ugly Cash, which gives users a yield on their balance because that yield is being generated in DeFi, even though Circle and so on haven't been allowed to pass it through. Although it was an exciting announcement about that recently with the SEC approval of Figure's product. So it's pretty cool.
How do you create trust for your protocol? And let me give you a little bit more context. It seems like there's a well thought mechanism behind this.
Mm-hmm.
There is a way where you're thinking of how to preserve wealth and how to actually I would say level the playing field.
Mm-hmm.
And you're thinking about it through different lenses, really taking the global economy more as a stage rather than a local economy as a stage. And so I'm always fascinated about the go-to-market strategy for these kind of protocols.
Yep.
So me as let's say a simple user, I'm how would you find me? And also maybe a weird question, but in the noise of crypto, where it's 1,000x, 10x, 10% or 20% usually is not even that interesting.
Yeah, totally. yeah, for this yield-bearing stablecoin that I was talking about, EUSD is what it's called, that's offered to users of Ugly Cash. I think even like ordinary young people who are like pretty financially savvy, they're already wary of DeFi and stablecoins, basically because of UST. And so a lot of the education is less like building up their understanding from the ground up, and it's more saying like, this is not a sketchy thing like that, and trying to explain why. So like I just saw yesterday a draft of a video that our team made to like try to explain that with some animations and get the point across. In practice, we've seen a pretty significant uptake where it doesn't seem to be an issue. Like people are happy to get the yield, and we're giving them the basic explanation that this is fully collateralized. There's no shenanigans here. But I think to get past that early adopter audience, I think our main tool is going to be like showing our faces and like just talking about it and explaining how it works. But in the bigger picture, I think stablecoin ratings are really helpful. We helped get Blue Chip off the ground, which is one stablecoin rating project, and then S&P has stablecoin ratings. I want to see those stablecoin ratings integrated into every exchange and every fintech app. Wow. So if you're going to like trade out of your, virtualist token into, Tether versus USDC, you can be like, oh, Tether gets a D. Why is that? Should I trade into something that gets a D? Right? I don't even need to understand what that is. If Standard & Poor's says it gets a D, like I don't want to hold it. But right now, there's still a little bit of a gap between those technical ratings and the end user on like a consumer fintech platform. We're starting to see some integrations, but I think more of that is the right direction to go.
That's interesting. You know what? I learned something. I've actually never thought of like a standard rating for stablecoins, which makes so much sense considering that there are so many stablecoins coming out there.
Yep.
And I was just thinking about like, how do you guide yourself through the noise? And not to say that stablecoins are noise or local stablecoins that are popping up, but it's like, for someone who's in the space, I'm getting overwhelmed.
Totally. I feel that. Yeah. I don't have time to go look into these things. Even, no matter how savvy you are, it doesn't matter. It's like, are you going to get in touch with the company and ask them questions about what is that asset really? Like, no. So check out bluechip.org. They would be a great interview for this series, actually, because they could walk you through their methodology and how they do that.
That makes so much sense. Talking about Reserve Protocol, what are the most exciting use case or successful use case that you want to talk about, like, and in which regions that you're seeing Reserve Protocol really making an impact or starting to make an impact?
Yeah, totally. So, one is this traction with, a US dollar stablecoin that's offering yield to consumers mainly in Latin America. The biggest asset on the Reserve Protocol right now is called ETH Plus. And it's more of a DeFi thing. It's not really making it into the real world yet. It's just an extremely simple way to take your capital and put it into ETH and get the staking rate without having to do anything, because it automatically rebalances across different liquid staking providers. So similarly, it's like, I don't have time to research, like, should I do Rocket Pool or Lido or like some of these other ones I've never heard of? That's like a decision I might not ever make, where it's like, okay, this one just aggregates them all. And like, there's, token voters who are like looking into it and figuring out what it should be. I forget what the market cap is. I think it's over 100 million though. It's like a pretty significant usage. And then, the thing I'm most excited about is very tiny because we just launched it yesterday. But it's this reserve index protocol that allows you to bundle together, really kind of any token on any particular blockchain that you're doing it on. And so like at launch, one of the cool ones is the Bloomberg Galaxy Crypto Index. So it's an index that Bloomberg Indices has maintained for a while. And this kind of works the same way as it does in TradFi, it turns out, where, Standard & Poor's for the S&P 500, they maintain their definition of the S&P 500 index, and you can go read about it on their website and so on. They don't actually manage a fund. So there is no ETF created by S&P for the S&P 500. They're just the index sort of tracker. And then lots of other companies create funds that track that index, and they pay S&P a licensing fee to use their brand and say, this is an S&P 500 ETF or whatever. Well, I wasn't sure when we were launching this, like, are index creators going to be happy with that same sort of licensing deal for DTFs? The answer is yes. A bunch of them signed up. We have like 14 different products at launch. Several of those are, CoinDesk indices is another one. And then, shoot, the name escapes me right now. Anyway, there's a further index provider that is the one behind the Coin 50, if you've heard of that, the company that actually does that index. Oh man, can't believe I can't remember.
It's all
it right
good. It
now.
will come back.
But so it's not that there's a lot of usage yet because we just launched it, but it's still very exciting to see that index creators are chill with this idea of like, yeah, create an on-chain version as opposed to a TradFi version and have it track the index and then see how big that gets.
Where do you think, do you think a certain region is more likely where you see stablecoin adoption going like rapidly, or is it not going to be regional specific?
Well, I think the standard story about how countries with capital controls or US dollar demand that's kind of in a gray zone being like places where stablecoins are in demand, that's basically true. It's a little bit hard to track it because, those things are happening in bespoke ways typically. But yeah, for many, many years now, there's, I don't know, hundreds of millions, maybe billions of dollars. I mean, yeah, it's like, yeah, even on our platform, we saw hundreds of millions of dollars of stablecoin transactions in and out of Venezuela a couple of years ago, with businesses using it to move their capital in and out of the country per month. So, we were just one platform. So it's definitely a big thing kind of happening in the background as a way to basically get portability of your capital in situations where it otherwise might be a little bit difficult. So I think that's, that has been leading already, and I think it will continue to lead for quite some time. But I'm personally also really bullish on just, I know everybody says that like, we in the US don't need these things because everything works fine. It's like, well, it kind of works fine, but there's a bunch of stuff that's like kind of annoying. So I personally am excited about just building up all of the basic infrastructure so that you could go to a grocery store and pay with a stablecoin and, manage your business accounts with multi-users and stablecoins and do invoicing and all of that stuff, taxes, all that stuff. And the infrastructure, as a crypto company, you end up dealing with all this. Doing accounting as a crypto company is a complete nightmare right now, especially if you do stuff in DeFi. Like there are many competing platforms that try to just look at the chain and figure out what happened and help you figure out your tax obligations. But really none of them is up to snuff because it's so complicated. So if we did manage to get to the point where like you could just super natively do all of that and it was just as easy as dealing with ordinary bank balances, I don't know. I think that there could be a lot of, especially cross-border demand in developed markets and eventually domestic demand.
So, you know what? Talking to multiple founders today, I'm very excited and I couldn't be more bullish on the future. At the same time, like, it's a pretty standard question, regulatory, like regulation.
Yeah.
How does it come in? Mm-hmm. All of these ideas are so disruptive. Mm-hmm. You're basically smashing the board.
Yeah.
And
sort of.
To be quite frank, the existing parties or institutions, not everyone benefits necessarily as well. Like you're taking a piece of their pie, and it's funny because you're saying, "Oh, governments have a monopoly on printing money," and kind of like taking that thing from them away.
Right.
How do you feel? How do you see the role of regulation in adoption of, let's say, stablecoins, but also something that I would like to add as context? Does this not scare you?
Yeah, scare me in terms of a consumer protection sense, or
consumer protection or adoption, or like also almost like where we're actually inevitably going is regulatory bodies, governments, institutions are coming into the space, and it's kind of like going from decentralized back to centralization again, essentially.
That terrifies me, to be honest. I'll tell you why. It's a legitimate thought to want to follow the money to stop crime, right? Like the basic money laundering prevention rules we have in place, they're there for a reason, and we can't ignore that. A lot of people want to just ignore that and say it's fine, but it kind of does matter, I think. But if you think about, it's like the simplest standard approach that's been taken a little bit so far with like tokenized security issuers that want to be compliant is like, okay, you can only hold the token if you're on a whitelist. You have to go through KYC with us to get on a whitelist. Well, that immediately makes it like very boring in terms of, you know, who all you can transact with and which DeFi platforms that can be a part of and so on. And so I actually think it's a really important challenge for the ecosystem to figure out technologically what is the most elegant open approach we can come up with that will do a good enough job of preventing criminal activity and preventing money laundering without breaking the composability of DeFi. And we actually, our company, Confusion Capital, has hired some people to basically try to jumpstart a think tank to work on exactly that problem.
Oh.
Because this year, you know, there's a lot of willingness from the new administration to solve these problems. But actually, if you sit down and try to like figure out like what is the answer, it is not at all obvious. And so it's called the Digital Securities Initiative, digitalsecuriesinitiative.xyz, if you're a geek about this stuff. And yeah, we're just doing like the deep thinking to try to figure out like what are the possible options. So yeah, I think that there's a real risk that we'll just end up kind of landing on a consensus of like, okay, you just have to KYC every token holder. And then you just have like these two disparate things of like the wild world of DeFi and sort of the contained, like sort of uninteresting, very hard to transact in walled garden here and another walled garden here, another walled garden here, and so on. Because yeah, that's an approach that's being taken a lot. It's like, hey, we have a blockchain where you have to go through KYC to get on. And so everyone can transact there and feel safe because we've done KYC at the beginning. Okay, but if there's 100 of those blockchains, you know, they don't talk to each other. So you're just kind of recreating, like you said, recreating the situation with TradFi where everything is disparate. Yeah, so if anyone watching this is working on that problem, please get in touch with the Digital Securities Initiative. We're thinking about it from like a generic level. We don't build technology in this space ourselves, but we want to do the research and development and support other teams that are. And we have some pretty good connections in the policy world and the rulemaking world if we have the right ideas. The bottleneck right now is actually the lack of good ideas.
I'll believe you because I don't know what the answer is. It's definitely going to be somewhat of a, I feel like, compromise. It's somewhat going to be, definitely going to be disruptive. Maybe actually no, it's not be the most exciting answer. I would say maybe most people think it's not the most exciting work, but I think it's so important because because when the time is there, you better have an answer. Because if not, it's kind of like
and
human
the time
nature.
is like now.
The time is now.
We need the answer like now.
And in human nature is more like, oh, let's just default to what we know.
Yeah.
And then you come into the world that I'm saying is that, you know, they come in, they own it, and like it's too late.
Yep.
And you just like back to square one. One thing I kind of want to talk about too is when you talk about reserve protocol and the way you have designed it. One of the things that I am very passionate about is financial freedom.
Mm-hmm. Mm-hmm.
And you know, most people or like kids that I talk to nowadays, it's like, do you know what money is? And do you know how capital can work for you?
Mm-hmm.
What's interesting to me is that more closer than ever, you know, financial freedom is like, it's closer to you than it was before ever. Let me provide some context.
Okay.
I used to think I need to have like 7 figures, 8 figures in the bank for like to be like liberated and like never need a job again. That's just not the case anymore with DeFi. You know, with DeFi now that amount is going lower and lower. Or
how come?
I think that because of the opportunities that are on chain, and I'm not talking about, let's say, airdrop farming or all other stuff, but it's about how capital can work for you. And you know, my parents or like the previous generation had double-digit like percentages of yield that were you know available to them. Those are just like in traditional, let's say, finance to the mass, like not that readily available. Whereas, you know, not financial advice, but like 20% yield is like not, you know, unimaginable. And then having savvy trading practices that are, you know, available on chain now to people that, you know, didn't have access to it before, enables them to have on a smaller portfolio being able to cover for their run rate.
That's an interesting point.
And so if you live in a location, like right now, recently I moved to Malaysia, where the cost of living is lower, you know, that amount gets lower because you have access to, let's say, the global economy. So you have access to stable coins that is in maybe a more stable currency, than what you're used to. Then you have yield opportunities that you didn't have before.
How confident are you that those yield opportunities would last a lifetime, though? It's like,
Well, that's a good question.
I mean, I guess, although to argue against myself, it's like, well, same thing's true for bank account interest rates.
Yes, that's a very good point. I think sometimes I feel like it will end, but it has not been ending.
Right.
It seems like, I think that what's happening is that the TradFi world and DeFi world are merging, where some of these opportunities where you have yield opportunities that are higher double-digit percentages.
Right.
I think most obvious answer is like Ethena. They're providing that to on-chain users. And I think that will continue for a minute, and maybe I'm like, who knows, who can look into the future. But I also think that there's an inevitable end. But I think that there'll be something else, that will follow up to that.
Yeah, but you can at least, as traditional yield comes on chain, you can at least easily switch between whichever yield is higher, the treasury rate or the DeFi rate.
Yeah, but it does feel like Reserve Protocol is like in that direction. It feels like you guys are enabling, let's say, a more, again, like leveling the playing field, saying, hey, providing that yield access, or like even like flatter purchase power, like, or more equal purchase power to, let's say, users out there.
That is certainly the objective.
Yeah, amazing. Well, Nevin, thank you so much for joining.
Thank you for having me.
And thank you for explaining. I definitely learned a lot, and it was a very insightful conversation.
Awesome. Nice to meet you.
Thank you.